Welcome. Today we're diving into Berkshire Hathaway, specifically the recent drop in their BRKB shares.
Yes, there's quite a bit to unpack there. We'll look at the factors like Warren Buffett's succession plans and the latest quarterly results.
Exactly. And we'll also touch on Berkshire's overall financial health, think cash reserves, the investment portfolio, and what analysts are saying right now. Investor sentiment, too.
It paints a complex picture.
It really does. So if you find this exploration useful, please do consider liking and subscribing. It helps us keep these deep dives going.
Okay, so let's start with the stock drop itself.
Right. So after the annual shareholders meeting, Berkshire's Class B shares, BRKB, they slipped about 2.7% in pre-market trading.
And that timing wasn't accidental, was it? It coincided directly with the big news about Warren Buffett.
Precisely. The announcement that he plans to retire as CEO by the end of 2025.
Which leads to the succession plan. Greg Abel is the name everyone's talking about now.
Yes. The board unanimously voted for him to step in as president and CEO. That's effective January 1st, 2026.
And Buffett isn't disappearing entirely, of course. He'll remain as chairman.
Right. Staying involved at that level. But besides the leadership news, the Q1 financial report also landed around the same time.
It did, and it certainly added to the pressure on the stock price. The report showed a 14% drop in operating profits.
14%, so down to $9.64 billion from what, $11.22 billion in Q1 last year?
Exactly, a noticeable decrease, and a huge chunk of that seems tied to the insurance side of the business.
The insurance underwriting profits took a big hit.
A very big hit, down almost 48.6%. That was a major factor in the overall profit decline.
Wow, nearly halved. What drove that insurance downturn specifically?
Well, a couple of significant things. There were catastrophic losses from the Southern California wildfires totaling about $1.1 billion.
Okay, that's substantial.
And then there was also a currency effect, a loss of $713 million linked to the U.S. dollar weakening against other currencies. That impacted insurance profits, too.
So wildfires and currency headwinds hitting the insurance results. But it wasn't all negative in the report, was it?
No, definitely not. Berkshire's energy division actually had a very strong quarter. Earnings there jumped 52%.
52%. To $1.1 billion. What was behind that?
Primarily higher utility demand, so that provided a nice counterbalance.
And BNSF Railway.
BNSF Railway performance was, pretty steady during the quarter. Consistent.
Okay. So getting back to the stock reaction, this recent drop, how significant was it in historical context?
It's been described as the steepest one-day fall for BRKB since the early days of the COVID-19 pandemic, so quite significant.
Right. The Class B shares fell around 4.9% to $513.17. And that was after hitting an all-time high just the Friday before, right? At $539.80.
Exactly. Some reports even mentioned a 6% fall specifically tied to the news of Buffett's planned exit.
Well, let's add some perspective here. Despite this dip, the stock had actually been doing very well this year overall.
Absolutely. Year to date in 2025, BRKB was up about 12% before this drop. That was significantly outpacing the broader market, which was actually, down for the year.
And the Class A shares, even better performance, wasn't it?
Yes, Class A shares were up 19% year to date in 2025. Compare that to the S&P 500, which was down about 3.3% over the same period.
So clear outperformance leading up to this. It suggests some investors perhaps see Berkshire as maybe a safer haven?
That's often the perception, yes, because of its large defensive insurance operations and, frankly, its very strong balance sheet.
Let's talk about what Wall Street analysts are thinking. What's the consensus rating right now?
Looking at ratings from the past 3 months, based on, I think, 3 analysts, the consensus is a moderate buy.
Moderate buy. How does that break down?
It's 2 buy ratings and 1 hold. No sell ratings in that group.
Okay. And do they have price targets?
They do. The average 12-month price target from those 3 analysts comes out to $519.50.
$519.50. So compared to the price just before the drop, that actually suggests a slight potential downside, around 3.7%.
Yes, based on that average target from the recent high. But there's a range, of course. The highest forecast is $557, and the lowest is $482.
Got it. And just to clarify for listeners, the main difference between Class A and Class B shares is primarily voting rights, right? Class A has them, Class B generally doesn't, and historically Class A had a much higher price point.
Correct. And on the analyst side, looking beyond just the ratings, there's some interesting commentary about the transition.
What are they saying about Greg Abel taking over?
Well, one view is that Buffett is sort of leaving behind a company that's actually less reliant on a specific investment genius than it used to be.
Meaning the underlying businesses are strong enough.
Exactly. The argument is that the company has very strong, predictable cash flows from its core operating businesses now. So operationally, not much change is expected under Abel.
And the culture. Berkshire has a very distinct culture.
The expectation is that the culture and the overall strategy will likely remain consistent. Abel has been deeply involved for years, after all.
Okay, that makes sense. What about broader investor sentiment? Is there a way to measure that?
There are scores for that. Currently, investor sentiment towards Berkshire is generally positive. The score is around 62 out of 100.
62 out of 100. How does that compare to others?
That puts it in the 74th percentile compared to its industry peers. So sentiment is more positive than about 3/4 of similar companies.
Interesting. Now let's talk about something Berkshire is famous for. Its cash pile.
Yes, the cash hoard. It hit another record high at the end of Q1 2025.
How high are we talking?
$347.7 billion. That's up from $334.2 billion at the end of last year, Q4 2024.
An enormous amount of cash. What are they doing with it? Or perhaps what aren't they doing?
Well, one trend that continued is that Berkshire was a net seller of stocks again in Q1, for the 10th quarter in a row, actually.
10th consecutive quarter of selling more stock than they buy. How much did they sell in Q1?
Net sales were about $1.5 billion. It seems to signal that they're still finding a lack of, compelling investment opportunities at prices they like.
So, holding on to cash, selling some stocks. What about the stocks they do hold? Is the portfolio concentrated?
Very much so. As of March 31st this year, 69% of Berkshire's equity investments were tied up in just 5 companies.
69% in 5 stocks. Which ones?
American Express, Apple, Bank of America, Chevron, and Coca-Cola.
That's a significant concentration. Some of those are quite defensive, like Coke and Chevron.
Right, and having that exposure to defensive sectors is seen as helpful, potentially mitigating some near-term risks in the market.
What about valuation? Is the stock considered cheap or expensive right now, even after the dip?
Well, according to Morningstar's analysis, the stock, even post-dip, might be trading at about a 9% premium to what they estimate as its fair value.
So not necessarily a bargain by that metric.
Perhaps not. But some analysts still argue that Berkshire's defensive businesses and that massive cash pile make it a useful complement to an equity portfolio, even at this valuation.
And the Q1 results, the ones that missed expectations, how are analysts viewing those in the bigger picture?
Some are essentially dismissing them as, quote, largely noise. The idea is that Berkshire's built to weather volatility, and one quarter's miss, especially driven by things like catastrophe losses, doesn't change the long-term picture significantly.
Right. The focus remains on the underlying strength and that huge cash position, which gives them options.
Exactly. That concentration in the portfolio means the performance of those top 5 names will heavily influence returns, but the cash provides immense flexibility for maybe acquisitions or buybacks down the road.
So to wrap things up, we've looked at this recent stock drop for Berkshire Hathaway, explored the key factors like the leadership transition and the Q1 results, and considered the outlook.
It's definitely a complex situation. You have the end of an era with Buffett stepping back from the CEO role, but a clear successor in Greg Abel.
And that's happening alongside these mixed financial signals, some weakness in insurance, strength in energy, and this just unprecedented cash reserve.
The transition itself, combined with how they deploy that cash in today's market conditions, really sets the stage for the company's next chapter.
Indeed. It prompts you to think about the implications, doesn't it? A new CEO taking the reins with nearly $350 billion in cash amidst a market that's, well, constantly evolving.
A fascinating scenario to watch unfold.
Absolutely. Well, thank you for joining us for this deep dive.
Thank you.
If you found this analysis valuable, please do like this session and subscribe for more explorations like this in the future.